Hey, how's it going everybody? I hope you had a fantastic new year 2021. Let's make it a year of wealth. Hope everyone's had a nice rest from the markets and it's time to get back into the game, right? What we're gonna go over is liquidity, why it's important for brokers, market makers to have liquidity, and considering the most liquid asset. Let's start from the beginning. What is liquidity? So liquidity refers to the ease with which an asset or security can be converted into cash, right? So in trading terms, this means how we can get in and out of positions quickly, right? Because don't forget, you need a buyer and a seller. Vice versa, you need a seller and a buyer. So if there's sellers, then there's buyers. And if there's buyers, there's sellers. So we can make quick transactions. If there's not enough buyers or sellers, then the pair won't be so liquid, right? So understanding liquidity, okay? So it's kind of like, it describes the degree to which an asset can be quickly bought or sold, okay, reflecting its intrinsic value. When we look at liquidity, we want to look at market liquidity. Market liquidity, it refers to the extent to which a market allows assets to be bought and sold at stable, transparent prices. Yeah. So, for an example, market makers will leave footprints of liquidity for them to get in and out of positions. For example, right here, they've left contracts down here for them to get in and out. They need to get in and out of positions, right? We're talking about the big guys. They need to get in and out of positions. So the market makers will leave points to get in and out of positions. So eventually when they sell, they can take profit at these points. So let's come back up. Here we go. They've taken profit and then induced sellers and then gone the other way, and they've left them there and then rallied back up again, induced buyers, left them there, dropped. So eventually someone's going to either hold contracts here or they will be stopped out. All depends on the contracts here, right? So if someone's hedging against price, there'd be contracts here for them to get out. So when price comes up here, they can easily get out their position because there'll be contracts, either pending contracts are left up here or open positions, right? So let's start defining some areas of liquidity, okay? As we can see right here, we had a liquidity zone right here. So where prices come up, induced buyers, and then dropped. At this price point right here, there's either pending orders or stop losses. So which induced buyers. So they've induced buyers right here, stop losses, wherever retail puts their stop losses, or induced sellers at this price point. And so at this price point, we can see this right here, right? So right here, they've induced buyers, which then probably put their stop loss down here or down here, depending on their mindset and how they're being taught. Stop losses are there for the buyers. It's because they think the market's going up, right? So they've induced buyers, as well as anyone who knows the game. There'll be contracts for sells at this price point with stop losses most probably above the liquidity points, and then they've sold it off, taken the stop losses along the way, all the way down. They've taken contracts right there, come all the way down, and again they'll just keep doing that again and again. And then the only time they release it, it didn't even release at this price point right here. So they still have pending contracts open at this price point. So if they need to take profit at this price area, then they know that they've got pending contracts at this price point where nothing has been set, where at the moment hasn't come up to that price point, right? Let's go and take a look at something that's going to be like GU, for example. Let's go and take a look. Well, I can go back and show you some backtesting. So as we can see right here, there was a high liquidity point at the time right there. Yeah, prices come down, left the contracts up here, and it's come back up, taking the rest of the contracts, and they opened up a buy position right here. Then we know that, so if they opened up a buy position right here, they could have took profit, and they know that they had pending contracts up at this price areas right here, because they make these liquidity points, right? And again, same as down here, they've taken orders, sold it all the way down, made an imbalance, and then from previous they've had orders here, and then from previous they've had orders right here, which when they come down, they've taken profit, created a new liquidity zone right here, new liquidity point right here, rallied back up, filled the imbalance, it's come back down again. This created another imbalance, filled the imbalance again, mitigated, and then rallied back up, took the new position up here, they need these points to get in and out of moves, right? And then once they've done with it, then they can go along their merry way, right? Retail traders know this is support and resistance, right? Not every support and resistance is a liquidity point. So retail traders, what they do is they would put their stop losses just above the high, try and sell, and then it's come back up, took their stop loss out. Always the typical way of how they do it, right? Again, nice liquidity zone right here. This is how they're creating all these points. So in this here was a rotation area, which accumulated orders. So this was a favorable price point area, and then they know that there's pending contracts at around this price area, right here. So they know that this is a favorable area and there's pending orders, so they need the pending orders there to get them in and out of positions, right? This is money for them, so they need it for them to move, right? They can't just make money out of nothing. They need these areas right here for them to get in and out of moves, and then to make money along the way. So they induce sellers in here. Once they induce it, then it goes the other way, and then they trap them, take all their contracts, away they go. And again over here, come back down, induce more sellers, and they'll just keep doing it, which gets them in and out of positions. They took more contracts here, they're taking more contracts here, to push price up, made an imbalance, come back down to mitigate, and right here, induce sellers, hit stop losses, again right here as well, taken pending orders, up it goes, took stop loss right here, and then sold off. So this is what they'll do day in and day out. But how do we recognize these high liquidity points? As we can see, we see that this is a favorable area. Again, right down here, we can see this is a favorable area right here too. We can see like wiki areas, right? Another one right here. So it's come up from one liquidity point to another. And when you see like these major pairs, this is where you'll see it the most, where you'll just see high liquidity points. On the minor pairs, you won't see it so much. Here you guys, a perfect prime example right here, and then sold off, made a move, and then stopped out anyone who tried selling, made an impulsive move. Right here, another impulsive move, and then going all the way up. We can do it on higher time frames. You see it on higher time frames as well. Usually I look at more of, I'll show you on the weekly, because don't forget, they don't sitting on the 1 hour, they're sitting on higher time frames. Traditionally, for example, you're going to be looking at higher time frames like these. Right here is a liquidity point, right? So if price come up here, took liquidity right at this point, then I know that they've taken any pending orders to sell back off, because they need the money for it to go a certain direction. And this was a nice prime example of high liquidity areas. Again, it's come down here. Well, don't forget, in the commercial world, commercials are always hedging against price, so there's always going to be pending orders or orders at these price points that go against price, because they're hedging against price. There's someone up here that bought GU, but then price went the opposite way because they was hedging against GU, and they come back up, take price, away they go. It will just keep doing it again and again. Right here too, there was one right here, price come down, took out liquidity to push price up, and it dropped all the way back down, created another liquidity area. So you want to be looking for points, liquidity points of interest. One right here as well. The price just kept taking liquidity points and then selling off. Don't forget, we're on a weekly, right? So these small little moves that you're seeing is big money. It's 2008. I'll go to EU. Let me have a look at EU. I'll show you. One right here. Price come up, take liquidity and drop, fill in any imbalances on the way. Another one right here. There's an imbalance in the market, so I expect price to come down at some point to fill in the gaps. Again, imbalances over here. We will even go on a monthly and have a look at high liquidity points. right here, and then sold it all the way down. I would say that would be a liquidity point right there too. And then it's dropped price all the way down, so it hasn't even come back up to this price point, but they know that there's liquidity at that price point. But don't forget, there's investors that invest for years and years and years, and if they need to get out of positions, they can, because they leave these footprints in. When we're looking into the markets, we want to be looking out for these footprints that the market makers are leaving for us. Yeah, and use it with our analysis. You see right here, look at this, one here, one here. So we could have took a short move down here, and it's taken it out at some point. They needed this to get out positions right here, to take liquidity right here and go their merry way. Again, you see this long wick right here, taking a liquidity point. Taking liquidity and gone. So you just have to just go out and backtest it. Just look at this area right here. So if you find the zones, you don't want to be entering straight on the zones. You want to be watching the price, seeing what it's doing. Don't forget, they need to induce traders to trade so they can take their money. I know it's a dog eat business, but that's how it is. That's how trading is. It's a nice point right here. It's come back out. It's hit liquidity, and then it needed to induce sellers, and then away it goes. Take as much money as they can before they move the direction. Right? And then it made an uptrend, made higher highs all the way up. So it's just something to keep your eye out on. Again, right here, induce sellers, and then away it goes. Trapping all the sellers, taking all their stop losses, etc., etc. That's what liquidity is. It's for the market makers and the big guys to get in and out positions. For us, and for the brokers, is to reduce the spread, to entice retail traders like us to choose them. Because if they have more participants in the market, the more lower the spread gets, and they will use that to their advantage. To have liquidity in the market, then they can keep moving their positions in and out, right? So go out, research about liquidity areas. Yeah, it's not something that you're gonna learn overnight, but you just have to keep an eye out on these key areas, right? And have a look at where you're placing your stop loss. Have a look at where your stop loss is and where it should be above these liquidity points. Because in the end, if we had our stop loss down here, it's come out and took in all your stop losses. Same again here. If we had stop loss here or stop loss here, this wick right here is taking all your stop losses, and then it's taking as much money as it can, and then it goes. Right? I'm sure you've been in a trade, stopped out, and it's gone the direction that you want it to go in. So that's exactly what it's doing. Okay, again right here, if you're trying to buy and you move your stop loss up, that's just taking you out every time. A nice liquidity point right here too. It'll come back down, test this, it'll come back down, take liquidity, come back up, and then go back, and then carry on its merry way. Induce buyers and then go the other way. So call them trap zones. Yeah, these are trap zones. So we have call them again, taking liquidity and then gone. So that's all they want to do, is they want to trap you into a trade. And if you're a day trader, man, you'll be over trading these positions all the time. Yeah, price will come back down, fill these. It needs to come back down. So yeah, I advise you to go out and back test this. Fully understand what liquidity is. If you Google it, there's plenty of websites that will tell you about what liquidity is. Yeah, go out, back test it, go and do some research, understand what liquidity means, right? But people will go, oh yeah, you've got to trade liquidity. They don't understand what you're talking about, right? If you look on YouTube, yeah, search on YouTube, how to trade liquidity, you'll see some silliness on there, right? You'll see some silliness that don't make sense. What liquidity means, you have to understand what liquidity means. It's to get in and out of positions. That's what it means. Is you want an asset to be liquid, so you can get in and out of positions quicker. And if there's more buyers and sellers, then that will give you an opportunity to get in and out of positions quicker. If you ever look at exotics, you see a higher spread because there's not many players in it compared to popular currencies like EU, for example. They'll give you a 1 pip spread or something like that because there's so many players. And that's how you can tell, is by looking at the spread on how liquid a pair is. Is by looking at the spread, because if there's more participants, right? So there's more buyers. So you have buyers and sellers, right? So we had buyers and sellers. So we have buyers and sellers, and the more participants are buying at certain price ranges, the gap between the two is the spread, right? The gap between the two is the spread, and most times it's about 1 or 2 pips because there's more players in the market on these popular pairs. If you went to this pair right here, I guarantee you the spread would be like 30 pips, 30, 40 pips. Or if you're trading out of hours pre-market, then you'll see the spreads widen up because it needs to cover the gap between the buyers and the sellers. That's all it is. So the less the spread, the more liquid a pair is, and that's how you'll find liquidity. And then you will see these footprints right here. And you will see these footprints right here. Took liquidity in and then ran for the hills. We see that this was a high liquidity point right here. It's taking liquidity and then dropped all the way down. So my take profit would be here. I'll be taking profit with the banks, with the smart money, all the way down, back up, back down. That's all it'll keep doing, creating these footprints. We had 2 here. Took out stop losses and then gone. Made a gap, filled the gap back up, and then just gone. So yeah, that would have been a nice trade if you got in right here, or got in down here, wherever. You'll see it. Go out, back test it, research about liquidity. Alright, you look after yourself, be safe. Like I said, make 2021 a year of wealth. Educate yourself. So if you found value in this, like, subscribe, comment down below for any questions, and let me know what you think. Let me know what you think about liquidity, right? Give me some feedback. What's your concept on liquidity? Because I know everyone's got different concepts, different opinions. everyone's going to have different opinion on something. So let me know what your concept is. All right, okay, cool. Take care, and I'll see you in the next video.